Okay guys, it's time for another week 8 video, and this week covers the trading week from the 22nd to the 26th of February 2021. Now our attention for this week's video will be the upcoming RBNZ meeting, where we think the MPC as well as Governor Orr will have their work cut out for them in order to strike a balance between the recent positive data that we've seen as well as the continued need for the very easy monetary policy. Now, I think the term better than expected has really been a very low bar in terms of the recent economic data that we've seen out of New Zealand. We've seen so many upside surprises coming out of the data. Starting with GDP, the Q3 numbers showed that activity has moved back above pre-pandemic levels, arguably one of the reasons why the bank started to push away from negative interest rates with that November policy meeting that we had. And according to Capital Economics, the recent activity index alone should be consistent with about another annual growth GDP of about 1.5% for quarter four. Now, the one caveat to that, of course, is if we just quickly take a look over to the retail quarterly versus a year ago numbers, a massive jump, of course, coming in to quarter three. And that alone, from a base effect point of view, can see a little bit of a move lower. And that, of course, can on balance affect the GDP number coming out of Q4. But the point is that we've already bounced back to higher than pre-pandemic levels in terms of growth. Turning to the labor market, another positive print that we had recently, annualized wage growth sat at 2%, with the unemployment rate coming in at 4.9%. Now, this was miles below the RBNZ's forecast, which actually saw unemployment sitting at 6.4% by the middle of 2021. Also turning to inflation, it's been solid. CPI year over year coming in at 1.4%, which is of course below the bank's midpoint target of 2%. But we also had recent 2-year inflation expectations coming in solid at 1.89%, much closer of course to that 2% midpoint target. And alongside that, we also had the RBNZ's inflation, the sectoral factor model, the very important core inflation metric, also coming in at 1.8%. So in terms of the economic data, things have been much better than both the RBNZ as well as the markets had anticipated, and the faster rebound was already acknowledged by the RBNZ to some extent in their November monetary policy statement, where the bank explained that they judged the funding for lending program, or the FLP, would be the most effective additional tool to provide stimulus as opposed to a negative OCR. Furthermore, the bank did of course say that the MPC does stand ready to implement a negative OCR if that is required. So, if the RBNZ didn't think that an OCR was necessary, a negative one was necessary with the conditions that we saw in November, it's highly unlikely that they would think so now after the slew of better than expected economic data that we've seen recently. And that is why we've seen a continued pushback from various investment banks regarding their expectations for a negative OCR coming out of the RBNZ in the months ahead. Now, of course, what about the virus? What about the recent lockdowns that we've had in New Zealand? I mean, given the short duration of the lockdowns, as well as the fact that the very first vaccines has actually been administered over the last couple of hours, which is of course Friday at the time of recording, the impact of the virus and the recent lockdown shouldn't be enough to derail the current positive momentum. So with everything looking so rosy right now, what will the main focus points be for the upcoming RBNZ meeting this week? Well, firstly, the bank isn't expected, of course, to make any changes to the OCR or any policy changes really, which means all the focus will fall on the accompanying statement as well as the press conference by Governor Orr, which is normally an hour later. Now, given the recent positive data, the market is expecting the MPC to acknowledge the continued improvement in the recent economic data and basically, sticking to their comments that the economy has proven to be more resilient than they earlier assumed, and the market is expecting them to upgrade their previous forecasts, which should of course be more positive for the Kiwi dollar. The bank will also be asked about their recent move to put in place more stringent loan to value restrictions, or LVRs, earlier this month, and then they did that in order to calm down a very hot housing market right now in New Zealand. Now, the restrictions of course was removed back when the pandemic started in April 2020. And after the recent boost that we've seen in housing prices, the bank has stepped in to basically increase those restrictions once again in order to calm down the buying frenzy. Now, the leverage associated, of course, with that recent frenzy did spark some concerns from the bank about financial stability, etc., and that prompted them to basically act by putting back firmer restrictions. Now, the reason why comments surrounding this will be important for us in this upcoming meeting is due, of course, to the implications that a rising house price can have on something like inflation, especially with the inflation expectations already increasing, with that sectoral factor model already sitting at 1.8%. That will be an important one to watch. But arguably, the biggest focus will be on the LSAP. With so many positives in play right now, it's only natural, of course, that many market participants have started to speculate when the bank will start to taper their LSAP, or the large scale asset purchase program. And to further add fuel to the fire, recent data has actually showed that the bank has already started trimming their purchases going back to last year. Now, the bank will need to be really, really careful here, playing their cards really right on why they have slowed their purchases, because even though things are looking better, the last thing that the bank would want right now is unnecessary tightening of financial conditions by a massive jump to the upside in something like the exchange rate, if the market thinks that, okay, this is the start of the end, so to speak, for the LSAP. So, they will need to be very careful, and they will be looking for a very soft landing and temper some of those expectations for tapering as much as possible, in my opinion, at least in this upcoming meeting. So to sum it all up, the bank has a lot of explaining to do right now, and it will be very difficult for them to balance that. Governor Orr will really, he will obviously want to acknowledge the positives in terms of that recent data we've seen, but still maintaining a bearish enough tone not to see the markets just ramping to the upside. The danger for the bank in that is that currently there's bullish expectations for the potential tapering sometime this year. And if the bank can't temper some of those expectations enough, if they don't come across dovish enough, that bullish expectation will evolve into something even more bullish of not when the bank is going to look to taper, but when the bank is going to look to hike rates next. And if that is the fact, if it turns out into that type of evolution in what the markets are expecting, that is definitely not something that the bank wants right now. Now, to help with this, the bank has something that they can do. They could look to provide firmer forward guidance in the form of the OCR by trying to pin it at a later date like 2023 or 2024, saying that will be the first potential date that they'll even think about something like higher rates, similar to what the RBA tried to do earlier. But whether that'll be enough to keep the Kiwi and something like the Kiwi 10-year at bay, I do have my doubts. I mean, we had the RBA coming out surprisingly increasing their quantitative easing with another 100 billion, and even though that did see that short-term move lower, I mean, if you just look at the Aussie dollar today where we're trading, it wasn't enough to change that medium-term outlook, and I really doubt whether something like that will be enough if the RBNZ comes out trying to pin the OCR at a later date. I really doubt whether that'll be enough to keep the Kiwi dollar lower. I think the bank will need to do more, because it's not only the domestic picture for New Zealand with the recent data, it's also the market's expectations for the global economy in 2021, and all of that favors pro-cyclical assets like the Kiwi dollar. So just do keep that in mind. So coming to potential sentiment shifts in a trade plan then for that meeting, scenario one would be the RBNZ throwing caution to the wind. So remember that the market's already expecting a more optimistic RBNZ based on the economic data alone. So the most bullish scenario for the Kiwi dollar would not just be a more optimistic tone from the RBNZ with the upgraded forecast, but would be more of an overly hawkish comment coming out from the bank, an overly hawkish tone, which alludes to a possible earlier tapering of that LSAP program, and also a downplay of the current downside risks for the economy. Now, our medium-term bias remains bullish on the Kiwi dollar, and if the above scenario does play out, it will just further cement that view and see further upside for something like the Kiwi dollar as well as Kiwi 10-year. And due to the recent choppy price action that we've had in the US dollar, our preferred way of expressing Kiwi strength or Kiwi upside was with a bullish bias on the Kiwi yen. And the only real risk to something like the Kiwi yen right now in the short term would be some possible mean reversion after the big push we've had higher over the last couple of sessions. We obviously in the terminal, we took advantage of some of these moves to the upside, you guys would recall from our prior videos that we did. So that will be the biggest risk, is a potential mean reversion move. But if we do see that top scenario, that bullish scenario playing out, we would expect further upside for something like the Kiwi yen. Now, in terms of scenario two, that would be the RBNZ accomplishing it, playing it very cool, and also bringing out the jawbone. Now, the last thing that the RBNZ would want right now is tighter financial conditions, and the fastest way for them to get that is with a rapidly rising Kiwi dollar trade weighted index. Now, the trade weighted index, the RBNZ one that you can see on the screen, that's the red graph. It's already 6% higher compared to where the RBNZ's prior estimates placed it. So the most bearish scenario for the Kiwi dollar would be if the bank completely downplays the recent positive data we've seen, stressing that something like easy policy is here to stay for a very long time, trying to push back against the idea of that tapering, and also potentially pinning the OCR to a very far away date. Now, all of that would be negative, but the most negative thing that we could see playing out, in my opinion, would be the bank directly jawboning the currency, explaining that it's way too strong right now, that it's a risk for the bank in terms of tighter financial conditions, and stressing that the bank would look to intervene if the speculative rise in the Kiwi dollar continues at the current pace. Now, we would expect, of course, something like this to pressure the Kiwi in the very short term, and since we are anticipating some possible mean reversion at some stage, that can create some additional downside for the Kiwi dollar, and that is something that you can look to take advantage of in the very short term. But the forward-looking nature of the market will mean that arguably, even if the bank comes out with that type of announcement, it will be able, the market will look through that. It will look through that facade fairly quickly. And we would still look to any massive pullbacks in something like the Kiwi coming out of that meeting as medium-term buying opportunities in something like the Kiwi yen. All right, guys, that is everything from my side. Hope you guys will have a fantastic trading week ahead. And as always, any questions, don't hesitate to let me know.